right, welcome back, everybody, to the Mortgage Guru podcast. We're dusting off the microphones here, getting ready to wrap up the year and head into a new year. Very excited about what 2023 is going to look like. Not to say that 2022 was a snoozer. It most certainly wasn't. Inflation dominated the headlines, Fed rate hikes right behind them. So we're going to talk about that a little bit because just this past week, the Fed made another rate hike announcement. But before we get into the week and some of the things that are going on, I wanted to let everybody know that the year in review, the 2022 financial markets year in review that I've been writing is now being put up on my blog. You can go to johncutsmita.com. That is easier to get to with just jcuts.com. That'll send you there. So that's letter J. It's the first letter of my name, John. Kuts. So jcuts.com. You'll see the market update blog posts. They're broken up into multiple parts so you can kind of digest everything. There is a lot of information there, a lot of charts. It's been a really volatile year. It's been so volatile I can't even get that word out. But it's been a wild one. It's been hard to keep up. As soon as it feels like we can kind of recap the week or the month, something crazy happens, and we see it across all asset classes. Whether it's stocks, crypto has really been grabbing the headlines lately. But October is one of the worst months. October, November, really kind of a 30-day timeline there is one of the worst periods in mortgage rate history. But at the same time, we also had within that one of the best days in mortgage rate history or in the bond market. It doesn't really help to have one good day in the bigger context when it's just been nothing but pain and tears for the bond market and interest rates all year. So let's get into that, because here we are. We're getting pretty close to the end of the year. The Fed hiked another 50 basis points, 0.5% this week on the Fed funds rate. That's an overnight lending rate. A lot of people don't understand the complexities of what the Fed can and cannot do. It's really not that complex, to be honest. They can only change that overnight lending rate. And there's some other types of things that they can do. There's the repo markets and some of the other stuff that they do in the interbanking lending markets. That's where it can kind of get a little complicated. But when we look at just the narrative of the Fed, wink, wink, quote, quote, raising interest rates, the only thing they're actually doing is increasing this overnight lending rate. And so there is a bit of a market response to that, but there's also a lot of, what's referred to as forward guidance. I think the path, as well as the potential steps that they're making along that path, are pretty well projected to the market. So the market tends to price these things in. They can kind of already see it coming. And so there's always a bit of that is the tail wagging the dog, because you have something like the Fed funds futures market. And so investors are buying options or placing bets as to where they see interest rates going to be further out into the future. So it's kind of blazing a trail or creating a runway for the market through which the Fed kind of feels like the market's giving them permission to keep raising interest rates. And part of that is on the back of where inflation has been printing, and there's different ways of measuring inflation. And inflation is still a big issue, and I think people are underestimating the Fed's commitment to really crushing inflation. And although the trend is rolling over, we're seeing month to month, we've had a couple months of inflation cooling a bit. I think this month the print was 0.2 for core CPI. It's a consumer price index. Core extracts food and energy, which are a bit more volatile. So on a month-to-month basis, it's a slight contraction. We've had such a huge uptick in the year-over-year number, where at one point this year in June, we saw inflation for CPI year-over-year come in at 9.1%. That's come down quite a bit. We're now floating around the sevens in the year-over-year number. The core CPI is in the low sixes. That ticked down 0.1%. So not a big move, but it's this overall trend that the market is watching. But it's not like we got to look at this for what it is. It's a metric that measures rate of change, right? So, inflation, even on a month-to-month basis, being up 0.2%, it's still higher inflation on a month-to-month basis. And we look at it, year over year. If next year inflation is flat, it's not like we're doing better as far as the purchasing power of our money, especially if wage growth is flat or wages are non-existent because people start to get laid off. So we're going to look at that or talk about that here momentarily as well, because I really think, maybe we'll just jump into it right now, because I really think that's the thing that people need to be focused on. So the Fed has been very transparent in terms of the things that they're looking at. They still feel that the labor market is tight. What that means is the number of job openings versus the number of people looking for work is very, very tight. So there's more than one job opening for every potential employee or job seeker. But some of that data is a little skewed and not necessarily as black and white as it seems. There's companies that will post job openings that don't actually feel like taking them down or don't take them down for one reason or another. Sometimes they post multiple. So those numbers kind of get skewed. The other thing is the actual employment figures are based off of a survey. And I've never really liked this, but the non-farm payroll report, the NFP report, is something that is also watched heavily all year long. In general, it always is in terms of the bond market, the economy as a whole, because the more jobs that are being added, the more likely you're going to see wage growth or pressure on wages to increase. And all of those things combined eventually cause inflation to go up a bit more organically than obviously we've seen the last year over year. So bonds have always been very sensitive to employment data, and particularly the NFP report, because bonds do not like inflation. And in a normal market where there's a bit more of a gradual incline to increasing inflation, investors are trying to kind of hedge and position themselves accordingly, because if you're owning a bond, it's great that you get that fixed income. But if inflation runs too hot, the value of that principal balance, which you invested, starts to erode. And when, you kind of look at a total return, you're not getting as much as you think when you're just looking purely at what that bond is yielding. So without getting too deep in the weeds onto that, let's take a step back and look at non-farm payroll, what we were talking about before. There's another survey that is also part of that, which is the household survey. And the household survey, it's done slightly different in terms of how they compile the data and calculate the data. And oftentimes things like multiple jobs are double counted in non-farm payroll, where in the household survey, those things are kind of looked at in a more granular fashion. And the household survey showing much greater weakness in the job market, the labor market, than the NFP report would suggest. But the Fed is sticking to kind of these core metrics that they've told the market that they follow, and they have followed for a long time in terms of making policy decisions and interest rate decisions for the overnight lending rate. And so employment looks tight. Wage growth is stable. Inflation, although is cooling or calming, I think is a better term, it's still very, very high. So although the Fed has raised the overnight lending rate 450 basis points this year, it was at zero in the first quarter of 2022. And here we are after the last FOMC meeting, the Fed Open Market Committee meeting, where they make these rate decisions. We just had the last one for the year, and the Fed is ending the year with the overnight lending rate at 4.5%, 4.25% to 4.5%. It's more of a range. But that's a lot of rate hikes in a very short period of time, less than 12 months. And they're being very clear. They're projecting out into the future that they're not done. And they use various types of data or information to pass their objectives on to the market. There's a thing called the Fed dot plot, which kind of like lays out where all the different Fed committee members and Fed banking presidents think that, the future interest rates, where they're going to be. It's all kind of this way of just hinting towards the market. So there's not a sudden shock that sends the market into panic, both because investors tend to be very reactionary and emotional, but also because the market is very heavily driven by algorithms and computers, and the wrong headline or the wrong response can kick off kind of a snowball effect where markets all start selling at the same time, even though it's completely unjustified. So the Fed has all these various mechanisms for getting the information out there. But at the same time, when we take a step back from looking at what the CPI, the inflation report is doing, what the employment report is telling us, there is definitely concern that we are going to see rapid contraction or slowing in the economy next year, particularly as early as at the start of the year in Q1. And because of that, when you start looking at how the market's pricing the yield curve or where they think interest rates are going to be, both controlled by the Fed and both, overall market influenced by the bond market, there's already more or less this time next year, there's expectations that interest rates, the Fed specifically, will already be cutting potentially over 200 basis points. So there's front running that goes involved in some of that forecasting and where they think the Fed is going to be. And so you have this expectation in the market that the Fed's going to pivot. Pivot meaning they're going to stop cutting interest rates. Stop raising interest rates, eventually start cutting interest rates, maybe even do more QE where they're buying bonds and all this type of stuff to add liquidity back into the market. These are some of the things I talk about in the 2022 year in review, the blog post I mentioned that you can read at johncutsmeta.com or jcuts.com. But some of these notions that the Fed is going to pivot sooner than later, even sooner than Q4 of 2023, it's only going to embolden the Fed to be more aggressive, because you see these moments where stocks start to go up a little bit and the bond market rallies, particularly on the short end of the curve, where short-term interest rates reflect a bit more of what Fed policy will be. And I don't think that's going to help our cause overall in the marketplace, because the Fed that's not going to help inflation actually cool down. And ultimately, history has proven the only thing that really does kill inflation is recession. And so the Fed does seem to be kind of hell-bent on taking us there through both, increased unemployment, which is an unfortunate result of recession, but inevitable. And some of the other factors that come with that, lower stock prices, potentially weakness in the housing market, which we're just starting to see. And that is something that will be worth talking about in Q1 of next year, is to see what kind of impact all of this is having on the housing market. But for now, the main thing here is the Fed's not, at least the way they're communicating, not going to be stopping anytime soon. So they've raised another 50 basis points this past week. We're now at 4.5% in the overnight lending rate. The potential that this tighter monetary policy, the lack of liquidity, because now they're doing quantitative tightening, again, something else I talk about in the market review, where they're no longer reinvesting money from the bonds that they purchased through QE. The liquidity situation in the markets is really, really awful. So as a result of that, you're seeing investors, particularly because inflation feels like we've seen the peak, at least from a year over year standpoint. So investors are getting a little more brave and starting to buy bonds again, but specifically they're buying bonds on the long end of the curve. And what that means is the longer duration bonds, so 10 years and up, where normally those longer duration bonds, because you're giving money to the government for a longer period of time, that's riskier. You should expect higher yields or higher interest on that. But the opposite is true right now, because the market is expecting or pricing in an economic crisis of some kind. A recession could be worse. And so because of that, they want that protection of slightly longer duration versus owning something more in the T-bill category, which is in that up to 5-year mark. So we're seeing huge inversions where, for example, the 10-year compared to the 2-year is inverted as high as 0.8%. It's a very, very dramatic inversion. So think about that. Investors would rather give the U.S. federal government money for 10 years and get less interest than what they could collect over a 2-year period of time. That shows the type of concern of where they think the economy is going over the next 24 months. And the inversions have been pretty intense at points. We've even had at one stage a 3-month and 30-year inversion. So investors at one point were willing to spend more money or pay more money for a 30-year bond than they would a 3-month bond, where basically in 90 days you get your money back. So there's a lot of other market dynamics that kind of like spill out of that phenomenon, but it's really, a big campfire smoke coming up and telling you that, there's a fire brewing underneath, and the market is warning of that. So it's going to be a very interesting start to the year. It was a very wild week. It's been a wild year. It's been a wild quarter. Like I said, we had a really rough 30 days between October and November. The 10-year Treasury was as high as it was in the 420 range. And we've since come back now. We're now below 350 basis points, or 3.5% on the 10-year. And so what that means is, the 10 years also inverted with the overnight lending rate, with the Fed funds rate significantly by 100 basis points. So there's a lot of flashing red warning signals, particularly in the yield curve, particularly in overnight lending rates. But the Fed is not showing any sign of stopping, probably if for no other reason than, as they've mentioned, there's still a long way to go on inflation. Employment is strong, but overall market participants just aren't getting the message. They're still being aggressive. They're still being risky. They're still kind of keeping inflation elevated by not taking these signals from the Fed seriously. And so I think the Fed's going to continue to raise, because they're going to have to, in order to kill what we call these animal spirits in the markets, where they want to time that pivot. And it doesn't look like the pivot's coming anytime soon, but we shall see. So thanks for checking in. It's going to be good to stay in tune with me and what's going on. I think next year is going to be a wild one. I think that's when things start to unravel a bit. This year, it happened all at once. Inflation prints started coming in red hot. The Fed had to respond in the obvious manner, raising overnight lending rates. We could kind of expect what kind of pinch that would have on the market and the economy. We've already started to see that. So what now are the longer term effects of raising 4.5 basis points, the most aggressive tightening cycle in history? We've yet to really see how that's going to unfold. But I assure you, we will see that in the first 2 quarters of next year. And I think the impact on the housing market is just starting to show. So we're starting to see cracks in the housing market. And I'm not here to say that there's going to be a housing crash. I think the jury is very, very out on that for some time. We don't have enough data or evidence. I think there's a lot of really low long-term fixed interest rate mortgages in the housing market right now. So although there's plenty of people who bought at the peak over the last 8 or 12 months, the majority of homeowners have a tremendous amount of equity, and they also have a record low rate below 4%. So they're doing well there, but most people, especially in my experience, are used to financing a lifestyle. And those short-term lending rates and the Fed fund overnight lending rate, that has a big impact on things like prime rate. And that's typically what unsecured debt and credit card and revolving debt is based off of. So you're seeing the cost to finance lifestyle and the ability to roll debt over like most homeowners and borrowers are used to, where it's like, yeah, I've racked up some debt. Let me just refinance my home, roll it in there, stretch it out over 30 years, and at the same time get a lower 30-year fixed rate than I had before. That's all gone out the window. So people are now kind of in a situation where they're starting to suffocate under these personal debt loads that typically they would be able to refinance and get themselves some more breathing room. That's currently not the situation. And, in the beginning of this year, before rate hikes really started to take off, the outlet for that, considering so many people had really great low first position mortgages or first mortgage loans, was pursuing a HELOC. Well, HELOCs generally are an adjustable rate mortgage. And even if not, they're a second lien mortgage. So they have greater risk. So if you look in October, we had 30-year fixed rates above 7%. So what do you think a HELOC is going to be? As a second position, higher risk loan, you started seeing the HELOC rates come in at, 10%. And so I think especially the ones, second mortgage loans in general were 9% and above, but the revolving ones that adjust, every month or, if you're lucky every year, the interest rates on those, we're starting to see a bit of interest rate shock for people. The HELOC outlet, even for loan originators, that was the big thing. Like, I can't sell 30-year fixed mortgages because everybody's got such a great rate. Let me push HELOCs or second mortgages. That proposition, that door shut pretty quickly, because with the Fed rate hikes and how the market responds to that and the influence that has on second mortgages, those rates jumped pretty quickly as well. So I don't think second mortgages and HELOCs are going to provide as much of an escape valve as everyone thought or would have hoped, simply because of how aggressive the Fed has been on what they can control, which is the overnight lending rate. But because of the inverted yield curves and the markets trying to get ahead of what's going to happen potentially next year with recession or worse, they're starting to buy long duration bonds. Mortgage bonds track the 10-year in the longer duration bond market. So we're starting to see mortgage rates improve a little bit. We've come back from the cliff. We are in over 7% at one short period. We're now in the low sixes. I think probably sometime this year, I wouldn't be surprised if things really do start to unravel and the market starts to kind of go for that safe haven trade of buying long duration bonds, that we do see 30-year fixed mortgage rates under 4% before the year ends. And if not, early, first quarter 2024 for certain. That's kind of what the charts look like. That's the mean. That's the average. I think bond markets find their footing again and become that safe haven trade once more when things start to kind of unravel, which we don't know if they will, but I think the Fed completing a soft landing is very unlikely. And I've written about the soft landing before, which is really just the idea that the Fed can raise rates without causing a recession. I don't think they can. They almost never do. The yield curve is almost never wrong, and it's telling us a recession is coming. The Fed has been very vocal about the awareness that they have that this could, their monetary policy, the tightening of monetary policy, raising interest rates, quantitative tightening, all that could impact the employment market and the housing market. And they've even gone as far as to basically say that that's their goal. So definitely stay tuned. It's going to be a wild ride in 2023, and I think it's going to be wild right out of the gate. And until then, if this is the last time I talk to you in 2022, I wish you a happy holidays, but I definitely look forward to recording one more message for you next week. So until then, take care. Thanks for joining me.